We'll be doing this podcast in 2050. He's like, we're still holding out.
Yeah,
we've renovated our house 42 times.
might be waiting a while for sure.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters, and today I'm here with John Martfeld.
Good morning.
And Eli Freeman.
How's it going?
Good. All right, so we're going to jump in here. Got two topics today. Might be a little bit shorter podcast today, but we'll see. John gets going, and sometimes it just
goes on forever.
Can't stop.
Rolls off the tongue.
That's right. So, all right. Before we jump in, remember to join the growing online community, the Market Moment community, by giving us a subscribe, like, comment. We appreciate all of that, and we look at each and every one, so we appreciate all of the support. So jumping into today, so Eli, this is a very real thing for you right now, mortgage rates and kind of what's happening in the world of rates, specific with mortgages. So catch us up on what's going on and what you're seeing.
We talked about this a little bit last week, but mortgage rates aren't directly, but they're pretty indirectly tied to the 10-year treasury. So if you want to go and look at, are mortgage rates going up or are they going down, you can roughly estimate that by going online and clicking on a 10-year rate. Well, the 10-year rate right now is pricing in a lot of cuts. The 10-year rate is actually at 3.7% right now, and that's down pretty significantly over the last month. So why you said it applies to me, we're looking at purchasing a house. We're under contract on one, and the mortgage lender called and quoted 6.1. And that's, what was it, 6 months ago that we were talking about 7.5%?
Yeah, I mean, it was definitely above 7.
It's been above 8, actually, for like a day.
It was.
Yeah.
It was nasty.
Yeah, so that's nice to hear 6.1.
8 to 6.1, that's a huge
swing.
Yep.
And just within the last calendar year that we've seen a 2% swing in mortgage rates. So I think if we were to title this episode anything, one thing that could make sense is 5% mortgages are probably coming sooner than later if things continue in the direction that the market is currently pricing them.
Yeah, which is a big deal, right? I think that you'll see some activity in the real estate world, people that might be open to, listing their homes because they're maybe not as scared about going and buying a different house.
And last time we had talked about the yield curve and the 2-year and the 10-year, and that's continued to shift in the right direction. So
not opposite of inadvert, right? Anyway.
We talked about that a lot. Trying to figure out how we say that. So not inverted, the uninverted did. And so the 2-year has continued to be less than the 10-year, which is just it's encouraging to see.
It's encouraging for the mortgage side for sure. And how many times we had clients in, you talk to them about their mortgage rates, and I have seen so many that are I've seen them as low as 2 point.
I saw 2.25 yesterday.
Yeah, it's crazy. 2.25 up to 3.75. And I still think if you're in that, you hang on that for dear life forever. But it's those above 4.
Please don't pay extra on a 2% mortgage.
Yeah, exactly. But if you're above 4 and the rates start getting down to 5, I think the movement in housing could pick up again. Right, on the people that are afraid to sell because they don't want to go back and pay 7% when they have a 2-3%.
If you're locked in at 3%, you don't want to list your house when you're going to have to go pay 7%.
Yeah,
but you might list your house if you go pay 5%.
Have you guys noticed how many new houses are being built? Right, that's been the new thing because people don't want to leave their house.
Right.
So you could have some pressure on the new housing market if interest rates fall. I mean, just because there'll be more inventory with people willing to sell their homes. So there could be pressure on some of the new home builders if that, I'm always thinking the negative side, that's what everybody thinks, but I'm thinking like how it would affect everything, right? The new home builders would be affected possibly negatively, but the housing market in general that'd be a positive thing.
Yeah, but new home builders have had some of the strongest years that they've had.
Oh yeah, they're doing just fine. But it's all cyclical, right? It's always about how am I doing today? Nobody talks about how great they did the year before. It's like going forward. So the news is always like like the housing industry, if it starts happening that way, we know they should be hoarding some cash right now, but that'll be a story 6 months from now if rates go down. And anyway.
Yeah.
So still positive. I like the news.
So when are you gonna buy a house?
Lord knows.
Hopefully rates plummet in the next 30 days.
I'm waiting. I'm holding out for a 2% mortgage
Yeah.
rate.
Yeah. We'll be doing this podcast in 2050. He's like, we're still holding out.
Yeah, you
We've
might be-
renovated our house 42 times.
might be waiting a while for sure. So next topic is one to talk about just the strength of, I don't know if not the strength, the broadening out of the market. We've mentioned this in the past. Just pulled up a very simple example here. When you're looking at the, kind of the FANG stocks, those leading, those mega tech, mega cap tech stocks that really, led the market for a long time. We've seen some volatility in some of those names as of late, right? Several of those names are well off their all-time high by 20, 30, 40%.
Yeah,
I mean,
NVIDIA,
not insignificant pullback on some of those names. And the S&P's held up pretty well. When you just look at the last 1 month, so the last 30 days, the S&P, the index has actually outperformed 5 of the 7 FANG stocks.
Which is just, we haven't seen that in 2 years, right?
Yeah, we haven't seen it in a long time.
So 2023, the 7 stocks that led the market, going into November of 2023, the actual S&P 500 less those 7 was negative. And those 7 boosted the S&P up, for that time frame. And then, of course, the year ended with everything positive. But the majority of that year, those 7 were kind of leading the way. And then they started this year leading the way. But it's nice to see it spreading out. It needs to for a healthy market, right? I mean, it's not sustainable that a market is lifted up by 7 names for a long period of time. So this is good news, I think. But like if you own those 7, I've had a lot of these questions. What do you do if you own the 7? And or should you panic? Should you get out? So NVIDIA is still the best in their class, right? Microsoft's still one of the best in their class. Apple's still the best in their class. So these stocks are still very strong, but it's just healthy markets when the other stocks start to perform.
When you look at the 5-year chart, the S&P is the worst performing. So when you look at the FANG stocks and the S&P 500,
sure.
the S&P 500 is the worst performer. Looking at those eight positions or stocks with the index, right? But then you start narrowing down the shorter time frame here recently, you start to see the S&P outperforming some of those names. And like I just said, over the last month, it's outperformed 5 of those. Year to date, it's outperformed 4 of them. And so, just some broader market participation, some strength in the names. You're going to have dividend stocks, utilities, some things with rates coming down, small cap stocks that we've seen some actual performance out of those segments of the market that we haven't seen in quite some time.
You've got information technology and communication services making up 40% of the S&P. So when we're talking about the FANG stocks, those are the 2 primary sectors we're talking about.
Yeah.
Now there's other companies in those, but those 2 sectors making up 40% of the stock market index. You start to say, okay, now the S&P is doing a little bit better. Then we're talking about financials, healthcare, consumer discretionary, industrials, staples, energy, utilities, a lot of the rest of the economy. And you would hope to see in a perfect economy moving forward, tech should be moving a little bit quicker. Because tech is the one that's going to be forward looking. But you can see financials, healthcare, the rest of the economy continue to just take steps, and as long as they're taking steps,
a side note on technology. I heard this today. We've known this in here, but the best technology companies in the world are U.S. based.
America,
right? I mean, we control the majority of technology strength, which is why the U.S. economy is leading the world pretty much, continuously, and why we are, when you look at those Mag 7 stocks that had done so well in 2023, and it's not a healthy, quote unquote, healthy market. However, they're the greatest stocks they're the greatest companies in the world. And so naturally, to your point, they're going to outperform most of the time long term. They should be.
Yeah, and you'll hear the argument, it's too expensive. It's like, okay, if I'm LeBron James, you pay me more.
Right.
Because I'm the
exactly.
best basketball
you're
player.
worth more.
And if you're worth more and you're the best, you should be compensated for being the best.
Exactly. You go back in time and look at like Apple stock in 2013. I remember it dipped down to like $90 a share. This is before 3 different splits. We talk about NVIDIA being such a high runner the last couple of years, but all of these companies from Apple to Microsoft and they lead the world. And this is why American economy is even though I think there's a little bit of pullback coming, I keep saying that, eventually winter will come.
Oh,
I mean,
sure.
Eventually I'll be
It's-
right.
It's coming. Sell everything.
But these companies that are so powerful in their American companies, they kind of keep our economy. They help us stay ahead of the world, I guess.
So going back to
it's a good thing.
looking at some of the strength and some of the names other than the FANG stocks, it's been a very recent move, right? You look at the last 3 years, the S&P has outperformed by more than double the equal weight S&P mid cap, and S&P small cap, right? So it's significantly outperformed. You start narrowing in on the shorter term, and things look a little bit different. Like you look at the last 6 months, the S&P's outperformed a little bit over the equal weight, but by 3%. And then the last 3 months, the equal weight has actually outperformed the S&P 500, and the small cap, the S&P 600, has outperformed the S&P 500 in the last 3 months. So again, we haven't seen this in a while, so it's good to see. Hey, the S&P and Nasdaq are not just far, just outperforming everything else by a wide margin. Not that that's a horrible thing, but it's a lot healthier and a lot more fun for us and clients when there's more than 7 companies.
Yeah, we're cheering for the little guys.
Yeah.
Right. Well, small company stocks, going back to small cap stocks since the Great Depression, have been the number one performing sector, period, by a long shot. And they have underperformed the last 10 years.
By a long shot.
By a long shot.
Yeah.
So if you think about like the tech stocks have outperformed for the last several years, I mean, it could go on for many years before that reverts back to the mean, if you will.
Right.
Just like small cap stocks have been underperforming for 10 years, but eventually that's going to revert back to the mean as well.
Right.
And I mean, small cap summer, hashtag.
Small cap summer.
Summer's over, basically. Small cap fall, hashtag.
small cap winter.
Yeah.
I'm having that conversation over and over with clients that market cycles and market expectations don't happen on 1 year, 1 month, 3 month timeframes. They happen on 10-year, 20-year timeframes, and you start to see themes and stories when you start to look back over 10, 20, and 30-year timeframes. There's a reason when you start to read good financial media, they're using typically 30-plus year histories, because a 1 year history is almost worthless. I mean, in the present day, it has its reasons and its stories, but in allocation and long-term planning, it has very little.
Well, allocation, think about, we have just started adding bonds, right, in the last year to our portfolios. Fixed income, and we hadn't done that for years before. And why? Because interest rates were just low for such a long period of time. But I remember back in the day when bonds were a part of that, that pie chart that you put together for a client, and they did actually work well as a diversification piece. That's coming back into play, but it's taken 15 years. There are people that have not been in this market for 15 years, or advisors that haven't been around for 15 years in the market, that haven't seen a bond rally like we're probably going to see here pretty soon, right? And that's it's
I remember my last bond rally. Those were the good old days.
When you look at, like, now I'm just playing with the charts. When you look at this, goes to reiterate your point on market cycles, and some things can last for a long time, right? We always talk about investing, how if your time horizon's 2 years, it's like that's like nothing, right? It's a drop in the bucket from an investing perspective. So, but if you look at, the early 2000s, so 2000 to 2010, right? You had the small and mid cap S&P 500.
Yeah.
Stocks were up, cumulative 63, 68%. Not crushing it. That's over a 10-year period.
Right,
so
right.
The average annual is 5-6% probably.
Yeah.
The S&P was down 24%.
Right.
Over that same time period, right? That's what they talk about, like the lost decade, and
Right.
where the S&P just didn't do anything. And so, and then you look at, kind of 2010 since, the S&P 500 has crushed.
Average
Right.
like 15%.
Yeah.
Right.
And so these cycles are not 3 and 6 month swings that you try to catch.
Oh, yeah.
They're typically, not that it couldn't be, but they're typically longer term trends that are driven by interest rate environment, economic growth, tax environment, just all kinds of
International
things.
policy, international business.
So, which is why you want exposure to, you want to have all of it in your portfolio. You wanna have
Now, I
exposure.
will say there's a debate tonight. I don't know when this is going to air, but today's
It'll be
Tuesday.
today.
There's a debate tonight. this debate is pretty important, right? Of the presidential election, we've talked about this a little bit. The one thing that can affect a stock market is tax brackets, right? If they're grossly out of whack, and if one of the things that are proposing is, unrealized gains, taxes on unrealized gains, and I know they're talking about only multimillionaires and so on. But if that type of stuff happens, you can take all this data and throw it out the window. They'll be selling on the market, right, just to get ahead of that policy. So I mean, I do watch like I don't want to watch it tonight, but I'll probably watch the debate tonight just to get my hands wrapped around which way we're going on that. And I think the market will too.
Yeah,
and I think tomorrow morning the market will kind of see which way they think the debate went, and if it's swinging one way or the other, because I think the higher tax side is going to be
that actually
nervous to the market.
Just happened in Canada. I listened to a Canadian fund manager, and he was talking through the changes that were going on in capital gains.
Yeah.
And it was fascinating because he was talking about all of the business people in America that were pulling their investments from his firm as well as from the firms around him,
right,
because of the change in capital gains tax. And so if you think investor behavior isn't impacted by policy, sure it is.
Sure it is.
We got to give Eli more to do. He's got way too much time on it. He's listening to Canadian tax
I know
podcasts or whatever.
Do you know what he's talking about?
They're good, eh?
No, good stuff. It will be interesting to see how tonight goes and how the market reacts in the morning. We might be talking about that next week, depending on exactly how that unfolds. So
come back next week.
Yeah.
Hey, is it 2 months from now, the election, right? 2 months from now?
Yeah.
Is it?
Yeah.
Exactly.
Yep.
Anyway.
So it'll be here before we know it.
Yeah.
Well, any parting thoughts? Kind of a quick discussion today, but a couple points we wanted to touch on.
Keep cash for the short term, invest for the long term.
Yeah.
Yeah. And I'm just very thankful that Eli didn't poke fun at the Hog fans today.
Yeah.
Because
we're not going to bring that up.
We're not going to bring it up where he's from. And
we strategically talk about college football when
Arkansas
fans want to talk about college football. So on that note, anyways, we appreciate you guys joining, and we look forward to seeing you guys next week. Thanks.